Okay, well, the private employment report, ADP, came in this morning worse than expected, down 298,000 jobs. Does this bode poorly for Friday's jobs report? Well, I'm joined now by Ward McCarthy, chief financial economist at Jefferies and Company. By the way, congratulations on your job move.
Well, thank you very much.
Okay, so what does this report tell you about the jobs report on Friday and how bad the jobs market really is?
Well, it tells us that the labor market's still weak. It's not as weak as it was before, so that's the good news. But we still have several months to go, I think, before we can expect to see job gains. And that's pretty typical for the early stages of a recovery.
Several months? That might even be optimistic, though, no?
It could be optimistic, but I think we'll at least go through the rest of the year before we can expect to see any gains in employment growth.
Ward, have you been surprised, though, at the pace in which we've seen job losses shrink?
Some of the early numbers this year were pretty scary.
Yeah.
And I think what it was just a very harsh reaction by management to the realities of the situation. So that did surprise me somewhat. However, we're continuing to see job losses primarily because the economy just is not generating momentum. Certain sectors are, but the sectors that are generating momentum are primarily the beneficiaries of some type of direct government stimulus.
Right. We'll get to that in a moment.
Okay.
But I do want to talk about, still stick with jobs, because
Sure.
Despite the numbers, and they can vary from month to month, of course, and week to week with the jobless claims, do they all still tell you the story that the economy is on a track to recovery?
I think so. We're still losing jobs.
Sustained recovery.
Well, I don't think we'll see a sustained recovery until next year. I think we're going to see a very bumpy recovery for the next at least 3 quarters. About this time next year, I think that we'll be able to be solid enough that we can have a sustained recovery. But we will see some pretty nice numbers. We'll see GDP over 3%, at least in Q3, and probably in Q4 as well.
Okay.
But I think we should restrain our enthusiasm for those numbers and understand what it is that's propelling them.
And maybe I'm going to put this in sort of a harsher way, but I mean, are some of these numbers, these economic numbers, the auto sales and things of that sort, those that are getting direct government stimulus, a head fake in many ways? I mean, you take that out, and it's still bad in those sectors.
Well, the purpose of that is to buy time. And that is a good thing. It is helping the economy to be a little bit more solid than it would be otherwise. But the concern is that down the road we'll find out how much of these car sales were borrowed from future months, and also in the housing sector with the tax break that first-time home buyers are getting. We're seeing some pretty good numbers for home sales too, but we're also going to find out when that runs out in November how many sales were pulled forward because of that as well. Right,
and you're seeing the markets right now. I was just talking about that with Joe Saluzzi. You're seeing the markets a disconnect now in the opposite direction, where you've got better economic data, but the markets, if you believe it as an indicator, a predictor of what's going on in the economy, seems to be suggesting that we should be cautious, that in fact we could see another leg down for the economy further on out.
Well, I don't know if we'll see a leg down, but I do think we'll see slower growth further on out. And frankly, I think the market reaction is the appropriate one at this point in time.
Okay. And Ward, just for next year, when the stimulus benefits all start to fade out, what's going to happen here?
First half of the year, I think we'll struggle. What we're waiting for basically is to reheal our financial system and also balance sheets for the consumers as well as businesses. Once we are through that stage, I think we'll be in much better position for the economy to start to grow on a sustainable rate.
And your forecast is what? For economic growth? For
economic growth, 3 to 3.5% for the second half of the year, something more than 1 to 1.5% for the first half of next year.
Okay, all right. Well, we'll have you back on, of course, to talk more about the economy and when those numbers all come out as well. Ward McCarthy, thank you so much for joining us, chief financial economist at Jefferies and Company.